And here you should see a picture of the Old Farmer's 1943 Almanac.
Posted year of publication, yeah.
There you go. And we see that the price then was 15 cents, and this was back in 1943. And even in 1943, it was in its 151st continuous year of publication, even back then in 1943.
Oh my God, I never knew that.
Yeah. Today we're going to talk about the economy and the market from an almanac perspective. And so we could start off here with a bit of a description that the almanac was a publication that contained a guide for the coming year and a forecast of the statistics and events. Very important to farmers' growing seasons. So kind of playing off that a little bit this year and kind of using that analogy that will give you a little bit of an almanac that relates to the economy and the market. Key components that we see as being important this year is that the consensus of opinion that the U.S. economy is going to continue to grow. And into a little bit of detail as to why we believe that. And we think it may accelerate to a 3% growth in 2014. We've had in the past more like the rates of 2%. Unlike this last year where we saw many stock indices returning 20-25% rates of return, we think this year it's going to be a little more measured, more in the 10-15% range for the stock market. And again, unlike in the past where made sometimes double-digit rates of return on their bonds with size of yields that will depress some of the prices. So we're going to see some of the yields that bonds generate go up measurably, but then again, the capital gains that people experience is going to be much less than they've had last year. So it's a little green, kind of like a traffic light here on the left with the green, yellow, and red. Some of the key factors that we think are going to contribute to that 8% growth is all back in 2013. There are a lot of budget negotiations going on in Washington, and what resulted from that were some tax increases on high-income individuals. It all resulted in some spending cuts that we're going to talk about a little more later. And we're just coming out of a European kind of double-digit recession. Stocks are, again, expected to rise. We also feel that their price-earnings ratio is going to rise as well. What does that mean? What it means is that the higher the P or price-earnings ratio gets, it tells you you're paying more and more for a certain amount of earnings that you're going to return from a stock. And people are very hesitant about the market. They want to demand very low PE ratios. But since they're feeling a little better about the market now, they're going to accept slightly higher PE ratios. We think that's good. So let's look at some of the other details here and where that comes from. We also see that investors are going to be taking a little more independent view from an investing perspective. In the past, investors had a tendency to worry about what the Federal Reserve is going to do and what are the taxes going to do, and we're starting to see a reversion back to fundamentals. Saw in today's Wall Street Journal, I think yesterday or today, that I think it was January was one of the all-time record months in investors got back into the market. So I think investors are shrugging off or seeing that some of these factors are a little bit behind them, and they're going to be looking to move ahead and base their purchases a little bit less on what they think Washington is going to do and a bit more on what they really see going on in the particular market itself. we're going to see a return to fundamentals of investing. We're reading the tea leaves and policy statements, and investors become increasingly independent of water policy. They're going to focus more on the reality and sustainability of growth and emerging trends. Now, what's kind of interesting is that tells us that economists, from a market perspective, back to our other chart here, are talking about maybe a 3% growth in the market, in the economy, a 3% growth. And while that may seem like a very aggressive number, it would really actually only return us to post-World War II averages. 3%, since we've been at 2 for so long, 3% is going to feel like the heydays. Look about it in reality, it's really nothing more than the GDP growth that we've experienced from World War II to about 2008. And that will lead to these 10 to 15% returns on stocks, pretty flat returns on bonds or fixed income. You may have read in the news or saw in the news or read in the paper that Congress has been continuing to raise the debt ceiling. So we see here where the debt has been rising, over the last several years from 2006 to 2013. But nonetheless, Congress has come forward and raised the debt ceiling. We actually had two raises last year, and we think it's going to continue. We think that finally the Republicans have realized that this cliffsmanship against the debt ceiling is a losing battle. Every time they've tried it, their popularity rankings have really dropped. So the last time they really tried it, didn't work out. And as a matter of fact, in October of 2013, when the last rise was necessary, Congress only needed 17 Republicans to vote yes, and 87 of them voted yes. So there's, in my mind, in our mind, if you will, that I have to step away from that strategy. It's just a loser for that. So kind of take that ceiling equation off the table here. Some investors ask us, what is passive investing? What is active investing? Investing is sometimes called buy and hold. So one of these that really came out with that strategy, that branding, was Vanguard. And Vanguard said in their minds that over a long period of time, you really can't beat the market. So you're better off buying the cheapest investment possible, so not to detract from your investment performance. Other mutual fund companies feel that with active investing, by selling, let's say, in a mutual fund, that they can temper some of the dips that maybe the market is throwing at them, and maybe they can capture sort of the gains on the upside that the market might be providing. Well, the bottom line is that the buy and hold or passive investing might work well if you have a 10 or 20 or 30-year time horizon, but if you've got a shorter time horizon, then we're finding definitively that active management is outperforming the indices, and particularly doing very well in times of great volatility. If you have a long event horizon and a relatively predictable, slowly rising market, passive investing might be your best bet. And if you've had the kind of markets that we've had with the volatility accompanying them, we're seeing that active investing is preferable. And active investing can be achieved through either rebalanced stock portfolios, as an example, active managed stock portfolios, portfolios made up of mutual funds, or portfolios that own or have purchased a variable annuity that contains funds themselves. Okay. of the fertile soil for the green, or the shoots for the stronger growth, we kind of as opportunities. Again, we're expecting the economy to grow from 2% pace of recent years to 3%, and this marks our first of consensus annual forecast in GDP growth, actually since 2005. So it's been quite a while since we've been able to come out and make this kind of prediction, which is encouraging. See in the yellow bar here, the gold bar, that our recovery in which we are experiencing today started back in June of 2009 and is running for almost 5 years now. We can see that it's the sixth longest running economic recovery that we've had sometime. But see, it's by no measure the longest. We can see where back 1991 of March 1991, we had an economic recovery economic expansion that lasted nearly 10 years. So while this is at 5, it's pretty much the midpoint, maybe the top 10 recoveries that we've had. So it's not a fluke, it's not an anomaly, and there's nothing to say that it can't last a bit longer. Think about the things that preceded economic growth. Looking backwards, we get 2011, the 12 and 13 consumption, essentially consumers buying slowed a little bit, particularly in 2013. Economic or consumer spending or consumption really slowed. We'll see there is in the green, we can, in the last couple of years, business capital spending has really constricted, but conversely, inventory has massively grown. So, in essence, businesses built up some capital in 11-12 to be prepared for 2013, and they've got essentially inventory on the shelf now. So businesses themselves are positioning themselves to get inventory to the consumer that they can be purchased. But in turn, they've also kind of suspended a tiny bit their own capital spending with a bit of a wait-and-see kind of attitude. The last 3 years that the government spending has actually been negative compared to previous years. Stocks have room to grow. Long-term interest rates remain still historically low. Corporate earnings likely to grow into the high single digits. Job growth improving, and if it's staying below 3%. I think we're in a pretty good position for a pretty good stock market. If we're to buy stocks, we see an above-average return for U.S. stocks and a below-average return for bonds. Well, let's step back here for just a second. Made me think of something. I've had a lot of questions going on not long ago about, well, what about this sequester? What these cuts? Well, some of the cuts that we've seen here, as an example, of the last 3 years, have measurably improved our total budget deficit. In 2012, our budget deficit was 6.8% of gross domestic product. Last year, it was only 4.3%. So like a 33% reduction in the budget deficit on a year-to-year basis related to the gross domestic product. Now, the sequester that everybody's kind of talking about was formulated back in 2010. And done, if you can believe it, because Congress couldn't agree upon a budget. And this was a little game of Russian roulette. It's okay, Democrats, if we can't achieve a budget in the next few years, then we're going to cut social programs. And Democrats said, well, that's fine, Republicans. What you're going to do, we're going to do then is we're going to reduce defense spending by funnily the same amount, about 17%. And that's what's got everyone freaked out now, is because Senators Ryan and Patty Monning are trying to come up with an agreement. And the sequester was going to require, right now, for the Defense Department to reduce their budget by 17%, and non-discretionary federal spending in terms of unemployment benefits and welfare, et cetera, would be reduced 17% as well. So kind of had both the Democrats and the Republicans holding a gun to each other's head and kind of waiting who's going to first pull the trigger. Started the political rhetoric. I read where Representative Howard, California, the chairman of the House Armed Services Committee, upon reviewing this potential 17% reduction in spending, or in defense spending, said, quote, "Better hope we never have another war." So, he's rattling his sabers. Ironically, even some of the negotiations that Paul Ryan and Murray are discussing right now might cause discretionary spending to hover around just under $1 billion. And it's quite surprising because President Obama had originally posed $1.2 trillion. Even Paul Ryan, when he first came out with his proposed budget a few years back, it was $1.1 trillion. So interesting that even this negotiated number that they're talking about right now would only move we're at with a sequester of about $986 billion to about $1 trillion. These negotiations are really, a relatively small amount of money if you really come down to it. So he has really inflated this, some might say a lot bigger than the real issue. I know. Look at, kind of historically, we can see that strong years for stocks, people think, oh, well, if I have a good stock market year, then that means automatically you're going to have a correction the next year. And this shows that back in that we've had some really good total stock market returns since 1927. We, as an example here, 1944, great year. 1999 had a great year. So I guess the moral of the story here is that because we've had a good year, it doesn't mean that the following year is necessarily going to be a bad one. Not always, if you just a rote action in the following year. As far as investing going forward, again, we're seeing that with the accelerated earnings growth and steeper yield curve, that's going to favor cyclical companies. And what does that mean? Well, cyclical companies would be companies that are going to do better during economic times. Perhaps companies that sell consumer items, electronics, TVs, appliances. And conversely, some of the defensive sectors that have done well during the market pullback, such as telecommunications and utilities, are not do quite as well. Because with interest rates rising, their dividends are less attractive. Utility stocks, as an example, don't rise too much in print value, but do pay a pretty high dividend. Well, if the consumer can go and buy, let's say, and get an even greater yield, it's going to make utilities less attractive. Some of these, reliable earnings indicators from businesses seem to indicate that earnings are continuing upward, and we hear in particular the ISM Purchasing Managers Index. Kind of looking forward, you see right at the very end there in 2013, the graph, you get kind of upticks. We're seeing, you saw the big downturn here at the end of 2008 where purchase managers really pulled back on expenditures. We'll see them tick upward as well. So that would bode well for them. When a market like this, recovering, typically the first ones that kind of pull out of the downturn will be large company stocks, because they're considered a little safer, maybe they pay a dividend. But we get to the point where we are now, where we're seeing improved economic growth, then we start to see medium-sized companies and even the smaller companies to start to really ramp up. So we make sure that we have some of those in our portfolio as well. Interesting, we look back here at bull markets and bear markets that we've had over the years. While stocks reacted negatively in 2013 when interest rates shot up sharply due to the fear that the Federal Reserve was really, if you will, terminating its bond buying program, we get market trend over the last 63 years that stocks can do well even if interest rates rise. So just because, and in fact, I think that most economists right now and most market forecasts really feel that the rise in interest rates have already factored in to a lot of forecasts. So still, we don't see, steady, slow, measured rises in interest rates necessarily negatively impacting the stock market. It'll impact the bond market much more. If you do have bonds, the way you can mitigate that a bit is by buying less long-term bonds and hold more to immediate-term bonds. Also, that companies in emerging markets are going to start becoming very much more attractive, again, due to global growth, and a lot of them are undervalued right now. People were afraid to buy them. With that, with a little more economic stability in Europe right now, a lot of the crises have passed us in some European countries, particularly those in the European Union, is good. With developed markets starting to pull out as well, starting to see some countries, if you ride the tail of the U.S. with their growth. We can say earnings growth in Europe has been negative for much of the past 5 years, but that's going to improve this year. Bonds, again, right now, I think some of us got a little spoiled and bonds provide us double-digit yields, double-digit total return through a combination of interest and capital appreciation. We much think that capital appreciation is gone now. So if you're going to own a bond, you're really going to own it exclusively for the interest that it generates. And we've been advising clients to hold with the commentary about active management. Move many clients out of individual bonds, actively managed funds made up of bonds. In particular, to continue to generate above average or above market rates of interest. A minute ago, if you do own bonds, you might want to, and you feel strongly about owning them, you want to tend towards intermediates as opposed to longer term. And intermediate term bonds will not be hung their rate of with their principal value if interest rates rise. Pretty flat reads for high quality bonds in 2014. About the only bonds that are going to give you any type of appreciation would be in the high yield or other niche sectors like preferreds. I said yield, high yields, maybe international holdings. We're looking here at what happens. Interest rates change, and you can see over here at the right, if rates increase by 1.5%, long-term bond could lose in the neighborhood of 15 to 16% of its principal value, whereas an intermediate may be only 4 or 5, short-term is 0 to 1%. I jumped ahead of myself, and here again, yield bonds and bank loans. Bank loans are actually loans to companies who cannot necessarily borrow money through conventional means. So a little bit more of a credit risk, but on the other hand, the rate of interest that they is so high right now that they're still very attractive. In particular, you can buy them in a mutual fund or maybe an exchange-traded fund. You don't have a lot of money tied up in one bucket. They are still very attractive. Again, bonds will decrease less here when interest rates rise. So while 4%, a 4-year maturity bond, which is a little over 0.5%, a 10-year maturity would lose over 3%. High bonds have in value a bit, so means they aren't going to be quite as attractive as they have been in the past, but attractive nonetheless. So again, we're tempering our prediction on performance of bonds as a whole. Investment-grade corporate bonds, good credit quality fundamentals are actually hypothetically be better purchase than treasuries right now because they pay a higher rate of interest, and if interest rates rise, since they're at a higher rate of interest, their actual value might increase less than a treasury. Bonds are still attractive right now. My only commentary here is, and maybe the reason this is here is there was a time, and because of concerns about being unable to fulfill their debt obligations, municipalities do have a unique characteristic that they are sometimes insured, or they can be sometimes backed by the municipalities can raise taxes to ensure that bondholders get paid. And there was a period of time there where municipal bonds, which typically pay lower rates of interest, were actually paying higher rates of interest than riskier alternatives. But I think this is going to slow down right now, but nonetheless, particularly for a high-income individual, municipal bonds can be very attractive. Municipal bonds be increasingly attractive in 2014, and they're a little less predictable than we think are here in the U.S., and again, that's why we're advocating an active fund approach for these types of investments rather than buying them yourselves individually. Praying, begging that in 2004 it'll be a time where we can tune out six in Washington. Believe it or not, we're going to have midterm elections coming up. We know it. So let's enjoy a little bit of peace and quiet here for a while. We can hope. This is just kind of interesting. It looks back at troubling or headline news items that have been going on last year. We had the fiscal cliff and the threat of tax increases, the sequester, spend cuts. Italy was having election issues. Cyprus was declaring bankruptcy. We had Boston Marathon bombing. We had market currencies plunging in value. Concerns midsummer about the Fed tapering its buying program. Syria started to come to the front page. Here we had a new federal chairman coming in. We have threat of another shutdown and debt ceiling. But look what happened. Through that, the S&P 500 still is by almost 25%. So you let these page news items keep you in the market. You had $100, you lost the ability to earn $25. Instead, went into a certificate of deposit, a CD, because you wanted safety. You invested $100, you got in 10 cents. So the market will continue to move forward. It may be a little bumpy now and again. But if it's part of your overall plan, there's sometimes we have to stick to our plan, even when it's not popular to do so. Just wanted to wrap that up with, behind the scenes, the Almanac analogy. This kind of fulfills the principles as we try to return to the basics of growing and preserve our portfolios in the years ahead. And, it's a bit of a time to return to a bit of normalcy. Last comment is in the, one of the things that is interesting is becoming very much noteworthy today is what do you do if you want to in the market, but you have an insurance policy on your money to be sure that you're not going to lose your principal. None purchases in 2013 were maybe in some cases realizing they had to get back into the stock market for reasons I just showed you, but they didn't go it alone, so purchased an annuity. An annuity is nothing more than purchasing the very same types of investments that you otherwise purchasing them through an insurance company as opposed to purchasing them yourself. And in return for doing that and the fee that the insurance company charges, you have guarantees. Those make a guarantee of return of your original principal after some period of time, a guarantee of no market loss on a year-to-year basis in exchange for sacrificing some market upturn or market gains. It might be a guaranteed death benefit or be a guaranteed income stream for you and your spouse for the rest of both of your lives. So, again, if you find yourself that you've been on the sidelines or you find that you agree that you need to have some stocks in your portfolio, we'd like to do it with some training wheels, if you will. It might be a product that you consider talking to your advisor about. So that I'll say thank you. I've recorded this and will be copying it over to my YouTube channel tomorrow. So if you go to Sikorski.com and click YouTube channel, it'll take you to this. If you want to watch it again or share it with somebody else. I'm going to stop recording and I'll be happy to answer questions.